It's 2026 and the IRS has released new changes to the tax brackets that affect those at and near retirement. These changes affect how much you'll pay in taxes, how your Social Security is taxed, how much room you have for Roth conversions, and even how much you'll pay for Medicare. So today, I want to walk you through what's changing, how retirees actually feel these changes, and where the real planning opportunities exist, as well as the tax traps. Let's start with the ordinary income brackets because these brackets directly affect things such as Roth conversions and IRA distributions, and even how pension income is taxed. It's important to note in 2026, the tax bracket rates stay the same, but the amount of income allowed in each bracket increases by around 3%. So in 2026, if you're a single filer, it's 10% up to $12,400, 12% up to $50,400, 22% up to $105,700, 24% up to almost $202,000, 32% up to about $256,000, and 35% up to about $641,000, and 37% for anything above that. Now that's for single filers. For those who are married filing jointly, the brackets are expanded a bit. Those amounts are 10% up to $24,800, 12% up to about $101,000, 22% to around $211,000, 24% to about $404,000, 32% up to $512,000, 35% up to $769,000, and 37% beyond that. Now, I want to remind you that we have what's called a progressive tax system because this is where a lot of people misunderstand taxes. Think of each bracket like a bucket. You'll fill the 10% first, then the 12%, then the 22%, and so on. So if you make $100,000, not all of that is taxed at the 22% rate, but more of that is explained in greater detail in the video above. Now, real quick, if explanations like this are helpful and you want more easy to understand breakdowns, go ahead and like this video and subscribe. It really does help others just like you. Next, let's discuss what most retirees take advantage of, which is this standard deduction. While in 2025, the standard deduction for single filers was $15,750. If you were married filing jointly, it was $31,500. And head of household was $23,625. Now, when you compare this to 2026, the numbers follow as such. If you're a single filer, it's $16,100. For married couples, it's $32,200. And head of household is $24,150. So when you compare the two, it's about a 2.5% increase. Now, if you're 65 or older, you also get an extra deduction. In 2026, if you're a single or head of household filer, you get an extra $2,050 deduction. And if you're married filing jointly or separately, or as the surviving spouse, you get an extra $1,650 per qualifying spouse. So for example, as a married couple over 65, in 2026, you would have a $32,200 standard deduction plus $3,300 in age-based deductions, making that a total deduction of $35,500. Now, when we compare this to 2025 standard deduction, that's only about an $800 increase. So even at the 24% rate, that's only a savings of a little less than $200. So this is nice, but it's not massively going to change how much you pay in taxes for the year. But here's where things get more interesting, especially for seniors if you're 65 or older. From 2025 to 2028, there's a new senior deduction of $6,000 per person over the age of 65, meaning up to $12,000 for a married couple. And here's what makes this so powerful for tax savings. This deduction applies whether you itemize or take the standard deduction. It also stacks on top of the age-based deduction that we talked about previously. So for a married couple over 65, you can have the deduction of $35,500, including the standard deduction and age-based deduction, plus another $12,000 from the senior deduction, which makes $47,500 in total deductions for the year. But here's the problem. This deduction phases out quickly. So if you're single and your modified adjusted gross income is over $75,000, you lose 6 cents of that deduction for every $1 over this limit, which means your deduction will be gone if your income reaches $175,000. And for married couples, that phase out begins at $150,000 and is depleted by $250,000. This means a one-time income spike, a Roth conversion done without planning, or taking too much income in the wrong year can erase a $6,000 or $12,000 deduction entirely. This makes the timing of things such as Roth conversions more important than ever because you're no longer asking, is a Roth conversion a good idea? Instead, you're asking, what deduction am I potentially giving up to do it? Now let's talk about long-term capital gains because this is an area of the tax code that causes the most confusion for retirees, and it's one of the easiest places to accidentally overpay. But before we look at the 2026 capital gains brackets, it's important to understand the difference between short-term and long-term gains. Let's say you sold an investment and realized a $100 gain. Now, if you held that investment for less than a year, this gain is considered short-term and is taxed just like ordinary income using the regular tax brackets we discussed earlier. But if you realize that same $100 gain and held that investment for over a year, it becomes what's called a long-term gain, which means you qualify for a separate lower tax bracket. The brackets we're going to look at only applies to long-term gains. And this is a big deal because long-term capital gains have their own bracket, and in some cases, those gains can be taxed at 0%. Here's what those 2026 long-term capital gains brackets look like. For a single filer, the 0% bracket applies up to $49,450. 15% up to $545,500, and 20% over that. For married couples filing jointly, it's 0% up to $98,900, 15% up to $613,700, and 20% for anything over that amount. And for head of household, it's 0% up to $66,200, 15% up to $579,600, and 20% over that. As you can see, this is where people get excited because paying no federal tax on investment gains sounds almost too good to be true. But here's the catch. Those income thresholds include your ordinary income. Think of things such as IRA withdrawals, pensions, interest, and wages. So if you're married filing jointly and your ordinary income alone pushes you past the top of the 0% capital gains brackets, that $98,900, then that same $100 gain would no longer be tax-free. You would immediately move into the 15% bracket instead. So here's the key rules that most retirees miss. Ordinary income can push capital gains to higher brackets, but capital gains do not push ordinary income into higher brackets. So just remember this because let's say you take a large withdrawal from an IRA in the same year that you realize long-term gains. Well, maybe in tax-free capital gains could turn into taxable ones. And one last thing to consider, even if your capital gains rate is 0% on the federal level, many states still tax capital gains as ordinary income. So depending where you live, just keep this in mind as there may still be a state tax bill. Next, let's talk about IRMAA. IRMAA is the Medicare premium surcharge that applies when your income crosses a certain threshold. So keep these things in mind. There is a 2-year look-back period, meaning your 2026 Medicare premiums are based on your 2024 income. And that IRMAA brackets act as a cliff, not a gradual phase. Here are what the IRMAA brackets and surcharges for 2026 are showing, both the effects of Part B and Part D. So please pause this video here to look at this in greater detail. But for example, if you're a married couple and your modified adjusted gross income is over $218,000, then you would pay a surcharge for both Part B and D premiums. So if you go over these thresholds by $1, then your Medicare premiums jump up for the entire year. That's why a single large Roth conversion or capital gain could cost you extra in Medicare premiums if not planned for carefully. Finally, with all these tax bracket increases, some have not been adjusted for quite a while. So first is the net investment income tax, which is an extra 3.8% tax that kicks in depending on your filing status and these threshold amounts. And unlike most brackets being adjusted for inflation, these thresholds have not changed since 2013. Next is the taxation on Social Security benefits. So depending on how you file, once your provisional income exceeds either 25,000 as a single filer or 32,000 as a married couple filing jointly, your Social Security benefits become taxable. And once you go over 34,000 as a single filer or 44,000 as a married couple filing jointly, up to 85% of your Social Security benefits are taxable. Also, these thresholds have not been adjusted since they were first established in 1984. So, what once affected the wealthiest Americans now affects many of them. And every year, inflation alone pushes more retirees into paying these taxes. And this is why things such as Roth conversions before taking Social Security or RMDs kick in are so important. So, as you can see, even with wider tax brackets and bigger deductions in 2026, there are many things to be mindful of in brackets that haven't changed at all. Social Security is a great example because once your income crosses certain thresholds, your benefits get taxed and faster than a lot of people realize. This is what's commonly known as the Social Security tax torpedo. In the next video, I'll show you how it works and how retirees can avoid falling into this common tax trap. Click this video right here. Have a happy new year. Thanks for watching, and I'll see you in the next video.